Now, I want to have a look at the economy now, and particularly some unusual aspects in this pandemic recession, and that is the way we're seeing house prices and mortgage take-up escalating right across the country. I'm joined now by business columnist for The Australian, the very esteemed Robert Gottliebsen. Always good to talk to you, Robert. We've been going through such a tough time over the past 12 months, of course, socially and economically. It surprises a lot of people the way housing prices are holding up and the way so many people are borrowing more money for housing. Should we be worried about this? Is there going to be a reckoning?
Well, there might be, but let's look at why this is happening. And it's extremely logical that this would take place. We'd put on a credit squeeze on houses. The banking regulators had told the banks, you be careful with what you lend. There were a whole series of very onerous criteria, all gone, all been taken off in the COVID time. At the same time, so suddenly there's a lot more money around. At the same time, we've lowered interest rates to almost token levels. You flood any market with that sort of money and have the money cheap, then you're going to get a rise in the price of the commodity, in this case houses. Now, it was held back a little bit by COVID, but once the COVID situation faded, off we went. Now, the good thing about that is that one of the major buyers are first home buyers. They have come back into the marketplace after a long absence. That's good for the long term in the economy. Yes, it's going up, and if it keeps going up too far, you'll suddenly see some of those clamps put back on credit. But we've done it, and it does increase the danger. But right at the moment, our economy, outside of the immediate COVID situations in say, tourism and students and education, things like that, the overall economy is going remarkably well. Is
it silly to worry about risks down the track? Of course, if there's a lot of debt out there, the two things that can really turn that into a real problem for us are, I suppose, a recession where people lose work and can't afford to repay their debt. Well, the other one, of course, is interest rates going back up again. It seems unfathomable at the moment, but if interest rates do go up, we could be very, very badly caught.
Well, right now, inflation is very low, so there's not much of a risk of rates going up. But we're altering our carbon economy. We're going to do a whole lot of things to save carbon that we wouldn't otherwise have done. That might well put inflation higher. We've injected a vast amount of money into the global economy, and it's not just houses that will go up in price. Other things may go up in price as well. So if you start to see inflation break out, then that's a real risk to interest rates. And the people who have borrowed large amounts of money at this point of time are very vulnerable to higher interest rates. The people I talk to, I say, look, these rates are very low. It's possible they could go lower, but you can afford this rate. Lock it in. Lock it in for 3 or 5 years to be on the safe side. You might lose a little bit, though. The rates may fall. That's a possibility. But you won't get caught on the other side.
Much better to be safe. Thanks so much for joining us, Robert. I really appreciate it.